On Wall Street, there are two worlds. The first is the one you read about in textbooks and see on conference panels. It's a world of clear rules, measured risks, and transparent leverage. Professionals will tell you everything is understood, contained, and under control. But then there's the second world, the one they never talk about. This world doesn't run on regulation or transparency. It runs on discretion, hierarchy, and a silent internal logic. Today, we're going into that second world. If you walked onto the prime brokerage floor of a major bank, you wouldn't see anything out of the ordinary. Just screens glowing, risk dashboards humming, and analysts at their desks. But underneath this surface lies a structure that's completely invisible. It's not in the financial disclosures, it doesn't show up in the accounting statements, and you can't find it in any audit. This is the world of the internal leverage bucket. This mechanism is so quiet and so deeply embedded in the DNA of prime brokerage that even many of the hedge funds using this leverage don't fully grasp how it works. They don't realize how their own risk is being shaped, separated, and magnified behind the scenes. These buckets aren't literal containers of money or assets. They are hidden classifications, invisible labels that the prime broker attaches to each client. They categorize clients based on their behavior, their trading strategy, and most importantly, the bank's own internal appetite for risk. Think of it like this. Leverage isn't just a single number, a simple loan. Instead, it's distributed through a secret, multi-tiered system. This system carves up the bank's books into unofficial risk territories. And based on which bucket you're in, the bank decides how much leverage you get, what happens when market conditions get tight, and whose positions get quietly trimmed long before a formal margin call ever goes out. This is where real market stress begins. It's not when asset prices start to fall. It's when a prime broker quietly decides that a client no longer fits the risk profile of its assigned bucket. That decision triggers a chain reaction. The bank starts making small adjustments that ripple through the client's portfolio, their hedges, and eventually the entire market. No regulator sees this happen. No investor hears a thing about it. This hidden decision-making engine is what determined who survived the Archegos collapse and who didn't. It's the reason why some hedge funds suddenly de-risk and sell off assets without any public explanation. It's how systemic leverage builds up in the financial system, even when the officially reported numbers look stable and safe. It's a shadow risk management system operating in parallel to the one everyone knows. And here's the crucial part. These leverage buckets are not static. They are constantly shifting. They change based on liquidity in the market, the bank's own inventory of securities, the quality of collateral being posted, and even internal bank politics. These buckets evolve faster than any outside observer could ever hope to track. By the time the wider market starts to sense stress, the first domino has already fallen inside these unseen buckets. The prime broker has already started tightening the screws, silently changing how much leverage a client can use. They begin to shuffle their exposures between different trading desks and pull back funding from certain clients. This cascade of internal constraints is what eventually spills out into the public market as forced selling and volatility. What we're talking about here is the real machinery of financial risk. This is the place where leverage isn't just extended. It's curated, rationed, and in moments of crisis, weaponized. The story of internal leverage buckets isn't just about how hedge funds borrow money. It's about how Wall Street quietly decides who is allowed to survive when the system begins to shake. It's about who gets sacrificed first to protect the bank's own balance sheet. Let's break down how this works in practice. Imagine two hedge funds, Fund A and Fund B, both are clients of the same prime broker. On paper, they might look similar. They might even have similar reported leverage ratios. But internally, they are in very different buckets. Fund A might be a long-standing client with a diverse strategy that generates a lot of trading fees for the bank. It gets placed in a platinum bucket. Fund B, on the other hand, might be newer with a highly concentrated, aggressive strategy. It gets put in a high-risk or tactical bucket. When the market is calm, both funds get the leverage they want. But the moment volatility picks up, the prime broker's internal risk models start to flash red, especially for the high-risk bucket. The first thing they do isn't to issue a margin call to Fund B that's too loud, too public. Instead, they might subtly increase the haircut on the collateral Fund B is posting. Or they might tell the fund that they are at capacity for a certain type of trade, effectively preventing them from adding to their positions. The portfolio manager at Fund B just knows that their prime broker is suddenly being difficult. They can't get the financing they need. They're forced to start selling assets, not because they've breached a formal margin limit, but because their access to leverage has been quietly choked off. Meanwhile, Fund A, in its platinum bucket, might even be offered more leverage to pick up assets on the cheap. The prime broker is using the crisis to help its preferred clients while cutting loose the ones it deems disposable. This is the hidden game. The prime broker isn't just a lender, it's a kingmaker. It decides which strategies are viable and which are not, based on its own internal needs and risk tolerance. And because all the major prime brokers operate this way, their collective, secret decisions can create market-wide effects. If several banks decide at the same time that a certain strategy or asset class is too risky, they will all start tightening the leverage in their internal buckets. The result is a sudden, coordinated sell-off that looks like a market panic, but was actually engineered behind the scenes. This is why understanding leverage is so much more than looking at a single number on a balance sheet. True leverage is about access, and access is granted or denied in these hidden, discretionary buckets. This system allows banks to maintain a public facade of stability while taking on or shedding massive amounts of risk in the shadows. It's a system designed to protect the bank first, last, and always. The client's survival is secondary. Once you understand this hidden mechanism, you will never look at margin calls, market stress, or leverage-driven sell-offs the same way again. Prime brokerage. To most people, it sounds like a modern invention, a product of the 1990s hedge fund boom, a fancy service desk for high-flying traders. But the real story is much older and much more secretive. It goes back to the 1970s, a time when Wall Street was scrambling to find new ways to make money after fixed commissions disappeared. Even back then, long before the term prime broker was common, the big dealers were quietly playing favorites. They had internal, unwritten rules to offer preferred terms to certain clients. Think of them as embryonic leverage buckets. These weren't formal systems. They were silent understandings among senior risk managers. A client with the right connections or a certain reputation could get more leverage, better financing, and looser restrictions than their risk profile should have allowed. It was all manual, all personal, built on handshakes and relationships. Everyone pretended the system was fair and uniform, but on the inside, they knew it wasn't. Then came the 1980s. Deregulation, financial innovation, and an explosion in hedge funds and derivatives. Prime brokerage went from a side gig to a central profit engine. The competition was fierce. Dealers had to offer more leverage, faster execution, and better terms just to stay in the game. This is when those informal favors started to become structured, internal systems. Those secret leverage buckets went from a quiet whisper to a documented, though still hidden, framework. A hedge fund might think its leverage was based on its portfolio's risk. But internally, the real decision was driven by dozens of other factors. How much revenue did the fund generate for the bank? Did its strategy align with the dealer's own market positions? Was the prime brokerage desk trying to hit a growth target that quarter? It was political, opportunistic, and completely invisible to the outside world. To regulators and the public, leverage looked scientific. Inside the prime brokerage, it was an art form. The 1998 long-term capital management crisis was the first major sign that this hidden system was a ticking time bomb. LTCM wasn't just highly leveraged. It was deeply embedded with multiple prime brokers. Each one had given LTCM massive unwritten leverage allowances, assuming the others would do the same. When the market suddenly turned, those internal leverage buckets started shifting. Some banks tightened their lending to LTCM before others. Some quietly cut off access to their balance sheet. What looked like a sudden collapse from the outside was actually a cascading failure, as one prime broker's secret decision triggered a chain reaction at the next. Regulators saw the margin calls and the panic, but they never saw the internal classifications that caused it all. You'd think regulators would have demanded transparency after that. But they didn't. Instead of being eliminated, the leverage buckets just got more sophisticated. By the mid-2000s, every major dealer had a complex internal system for sorting clients into invisible categories. A client in bucket A might get 8-to-1 leverage, while a similar client in bucket C was capped at 4-to-1. But no one ever told the client which bucket they were in. This created a dangerous game. Hedge funds would shop around, taking maximum leverage from the most generous prime broker, while letting stricter ones think they were being conservative. No single prime broker could see a client's total leverage, and the client couldn't see the bank's true risk limits. Then came 2008, the global financial crisis. As markets froze, those internal leverage buckets started shifting at lightning speed. Some clients had their leverage cut in half overnight. Others were suddenly hit with massive margin calls on positions they thought were secure. A lucky few, the preferred clients, were protected at first, only to be thrown to the wolves when the banks themselves started fighting for survival. The massive deleveraging that rocked the hedge fund world didn't start on public exchanges. It started with a quiet reclassification inside a prime broker's secret ledger. A fund could look stable 1 minute and be forced to liquidate the next, not because its trades went bad, but because its bank silently moved it to a higher risk bucket. Even after the disaster of 2008, Dodd-Frank and other regulations barely touched this system. Prime brokers successfully framed their leverage buckets as simple, internal risk management tools, not as a core part of the market's plumbing. So they remained hidden, and they became even more powerful. Now they were algorithmic, data-driven, and updated in real time. A client's bucket could change based on dozens of variables, from intraday market volatility to the availability of treasury bonds as collateral. They were no longer just guidelines. They were the automated, embedded architecture of modern leverage. If you need any proof that this system is still a major source of risk, look no further than the Archegos collapse in 2021. Archegos was able to build up an insane amount of leverage because it was spread across several prime brokers and none of them knew the full picture. But the real problem was how their internal buckets reacted under stress. Some banks started tightening leverage on Archegos early. Others waited until it was too late. A few even kept extending more credit because their internal models flagged Archegos as a strategic revenue client. When the house of cards finally fell, the order in which the banks liquidated Archegos positions wasn't based on public rules. It was determined by their internal bucket hierarchies. That's what decided who took billions in losses and who got out relatively clean. Today, these internal prime brokerage leverage buckets remain one of the most important and least discussed parts of our financial system. They aren't in any public filings. They aren't disclosed to clients. They aren't monitored by regulators. Yet, they control billions of dollars in market exposure. They dictate how much risk hedge funds can take, and they determine the speed of a market crash. They are the silent engine of leverage, shaping market stability long before the public ever sees a sign of trouble. The system is more automated and more complex than ever, which only makes it more dangerous. Because when the next crisis comes, the first tremor won't be a price drop you see on a screen. It will be the silent reclassification of a client deep inside a prime broker's hidden system. And by the time we see the effects, the market will already be unraveling from the inside out. For years, the world of high finance operated on a somewhat predictable model. Hedge funds knew how much leverage they could get from their prime brokers, the giant banks that provide them with financing. Margin requirements, haircut schedules, and regulatory charges were all fairly standardized. Funds knew the limits, and naturally, they pushed right up against them. It was a high-stakes but transparent game. But then, everything changed. What changed wasn't a new law or a catastrophic crisis. It was a realization inside the prime brokerage desks themselves. They saw that leverage had become too visible, too easy for hedge funds to max out. They noticed a pattern. Whenever they tightened the formal terms, funds would just find a way around it. They'd spread their risk across multiple brokers, use complex derivatives to get synthetic leverage, or pivot to strategies that exploited gaps in the bank's own risk models. It became an unsustainable arms race. So, the prime brokers, or PBS, got smarter. They evolved their internal systems, turning simple risk classifications into a dynamic, adaptive architecture. They created what we can call internal leverage buckets. And this is where the genius and the danger of the new system lies. The big twist wasn't that PBS decided to tighten leverage. It was that they began tightening it invisibly. Imagine you're running a hedge fund. Suddenly, you notice that getting financing is a little slower. Your requests for more leverage are perpetually under review. Access to intraday funding, which used to be instant, is now mysteriously constrained. On paper, nothing has changed. Your margin rate is the same. Your official terms are the same. No rule was broken. No new regulation was passed. But you can feel it. The heartbeat of your relationship with the bank has slowed down. What you don't know is that, internally, you've been moved. Your fund has slipped into a different, more restrictive bucket. Why? The reasons are a black box. Maybe the correlations in your portfolio crossed some secret threshold. Maybe the bank's internal models predicted they'd need their balance sheet for something else. Maybe your strategy started to look too much like other high-risk clients. Or maybe, just maybe, you weren't profitable enough that quarter to justify your old level of access. Whatever the reason, the shift happens in silence. And this is where the real danger begins. The hedge fund, completely unaware of its new classification, keeps operating under its old assumptions. It builds positions expecting financing to be there. It hedges its risks believing the bank's tolerance is unchanged. It allocates capital thinking its runway is long and stable. But inside the prime brokerage, a different clock is ticking. Their systems have already flagged the fund as higher stress. Their models are allocating less balance sheet to you. They are already drawing up contingency plans for your liquidation. To the bank, this is just prudent preparation. To the fund, everything looks normal. Until it isn't. The truly critical moment, the twist that can unravel markets, is when multiple PBS shift their buckets at the same time. C. A hedge fund with several prime brokers thinks of its leverage as additive, a little from this bank, a little from that one, but the banks see it as competitive. If one PB downgrades a fund because of rising volatility, the others don't need a phone call to do the same. They just notice the fund suddenly trying to draw more aggressively on their balance sheet, and they react. What the fund sees as one bank pulling back is actually a domino effect, a quiet reverberation across the entire system as every PB recalculates its own risk. Suddenly, the fund's once stable financing becomes erratic. Requests are delayed or only partially filled. Questions about their margin get sharper. Portfolio reviews become more frequent and intense. And then, when the market makes a sharp move, The PBS that had already moved the fund into a tighter bucket can act in minutes. They can pull the plug while the fund manager is still trying to figure out how much leverage they actually have, based on assumptions that are now dangerously out of date. This gap, the difference between the leverage a fund thinks it has and the leverage a bank is actually willing to provide, is the pivot point. This is what turns a quiet internal recategorization into full-blown market stress. Forced deleveraging doesn't start with a frantic margin call. It starts with silence. The silence of a financing desk that stops extending overnight credit so generously. The silence of a risk officer who suddenly stops returning calls. The silence of a system that now routes every request through 5 extra layers of approval. These signals are subtle, but they are lethal, because by the time a fund manager recognizes them, it's too late. They're already trapped in a more restrictive bucket, and the bank's liquidation plan is already in motion. But the story goes even deeper. The PBS internal models don't just look at individual clients. They scan for rising systemic fragility across the entire market. These models are proprietary, top secret. They track things like internal inventory swings, the concentration of risk with certain counterparties, and hidden exposures buried deep inside derivative books. When these models flash red, signaling elevated stress in the system, the bucket downgrades accelerate. A fund that might have been reclassified once a quarter could now be shifted twice in a single week. Some banks even have real-time engines that automatically rebucket clients the instant volatility spikes. The client never knows the moment it happens, but the consequences are immediate. Access to the bank's balance sheet tightens, flexibility evaporates, and the bank begins preparing for an unwind before the client even suspects their risk profile has changed. And this brings us to the ultimate revelation, the secret that turns the entire system inside out. Leveraged funds don't just collapse because markets move against them. They collapse because prime brokerages change their internal buckets before the market even knows trouble is brewing. The first real signal of a crisis isn't a stock chart plunging, a credit spread widening, or a volatility index exploding. It is the soundless, invisible movement of a fund from one unseen bucket to another. A movement that dictates how much leverage it can get, how quickly it can be financed, and how soon the first forced sale will happen. This is the moment that insiders recognize as the real beginning of the end. Not when prices fall, but when the banks quietly begin to protect themselves. Inside every prime brokerage, this machine decides the fate of billion-dollar hedge funds long before you ever hear about a margin call or a market crash. When we think about leverage, we usually picture a simple ratio like 5-to-1 or 10-to-1. But that's not how it works. Prime brokerages, or PBS, don't use a single number. Instead, they use a complex web of internal classifications, secret risk codes, and real-time algorithms. They sort their clients' hedge funds into invisible buckets. These buckets determine everything: privilege, constraint, or even a controlled, quiet unwinding of a fund's entire portfolio. A hedge fund might believe its leverage is based on its strategy or its fancy risk models. The reality? Its leverage is determined by its rank in the PB's internal hierarchy. And this hierarchy is constantly changing. It doesn't just respond to the fund's trades. It reacts to the bank's own liquidity, its inventory, its regulatory pressures, and even strategic goals that have nothing to do with the client. So, how does this hidden world of leverage buckets actually work? It all starts with something called balance sheet allocation. Every major prime brokerage operates under strict limits. Think of it like a salary cap in sports. They have regulatory capital rules like Basel III, which demands a certain leverage ratio. They have internal stress tests and company-wide targets for how much risk they can take on. For example, during the Treasury market chaos in 2020, big dealers were running at nearly 95% of their internal risk limits. There was simply no more room to lend. This creates an invisible ceiling. But beneath that ceiling, PBS creates suballocations, basically smaller pools of their balance sheet dedicated to different types of clients. One bucket might be for low-risk, market-neutral funds. Another is for aggressive macro funds. A third might be for quantitative funds that trade thousands of times a day. Each of these buckets has its own secret leverage cap, its own rules for liquidation, and its own sensitivity to market stress. And here's the kicker. None of this is ever disclosed to the clients. Why? Because if the funds knew the rules, the bank would lose its power to dynamically manage its own risk on the fly. Now, let's go a layer deeper to the internal risk models that feed these buckets. PBS use their own proprietary tools value at risk engines, stress scenarios, and concentration scores that are often far more conservative than the models their clients use. For instance, PBS apply what's called an internal VAR multiplier. A hedge fund might calculate its risk, or VIA, at 20%. But the bank, anticipating a market crisis, might apply a multiplier of 2 or 3. Suddenly, in the bank's eyes, that fund's risk profile isn't 20%, it's 40% or even 60%. Without making a single trade, the fund has been silently moved into a more restrictive leverage bucket with its borrowing power cut. Next up is the problem of crowded trades. PBs don't just look at a fund in isolation. They look at their entire client book. They track how many funds are piling into the same positions. Remember the craze for FAANG stocks a few years ago, or the rush into Chinese tech in 2021? When a PB sees that a huge percentage of its clients, say 40%, are all holding the same stocks, alarm bells go off internally. Leverage buckets for those trades tighten automatically. A fund might be low risk on its own, but it becomes high risk in the aggregate simply because everyone else is doing the same thing. This is a hidden fault line. Leverage isn't personal. It's communal. And this creates a silent fragility that can spread across the entire system. Then we have correlation stress modeling. PBS know that in a crisis, everything that's supposed to be diversified suddenly moves together. They don't just look at simple correlations. They use complex models to simulate how different assets will behave in a market crash. Research shows that during events like the March 2020 crash, correlations can spike by 200 or 300%. PBs bake these extreme scenarios into their models. So, as soon as their systems detect that correlations are starting to creep up, even before prices have moved much, leverage buckets start tightening. A fund might think it's safely diversified across 20 different positions. But if the PBS model determines that 12 of those positions will act as one under stress, the bank sees the fund as highly concentrated. The PB can then slash its balance sheet allocation to that fund without any warning or change in terms. Another critical factor is funding liquidity. PBS aren't just lending out their own money. They rely on short-term funding markets, like the repo market, to finance their clients' leverage. When the cost of that funding goes up, the economics of lending change dramatically. In 2023, we saw several periods where key funding rates spiked. These small changes, invisible to most hedge funds, can make providing leverage unprofitable for the PB. If the cost to finance a client's portfolio suddenly outweighs the fees the PB is earning, that client's leverage bucket gets downgraded. The fund won't get a notification. They'll just notice that their trades are settling slower, getting new positions approved is harder, and the bank is less flexible. The system is tightening around them, all because of a tiny shift in an obscure funding market. Finally, we have the PB zone derivatives exposure. PBS run massive complex derivatives books to hedge their own risk and their clients' positions. They use futures, options, and swaps that all require their own collateral and margin. If the market for these derivatives gets volatile, for example, if the VIX, the market's fear gauge, suddenly triples, the PB has to post huge amounts of its own capital to maintain its hedges. Where does that capital come from? It gets reallocated from other areas, including the leverage buckets for its hedge fund clients. During the COVID shock, PBS had to pull back massively on providing leverage to funds that use swaps or other synthetic instruments. They needed that balance sheet capacity for themselves. The hedge funds never saw the internal chaos. They just felt the credit tap being turned off. So, what does this all mean? The seemingly stable world of hedge fund leverage is built on a foundation of sand. It's governed by a secret internal system that is constantly shifting based on the bank's own needs, risks, and profitability. A fund's access to capital can be cut off not because of a bad trade, but because of a crowded market, a shift in correlations, a spike in funding costs, or a crisis in a derivatives market they have nothing to do with. This is the hidden architecture of modern finance. It's a world where risk is managed in the shadows, and the rules of the game can change at any moment without any warning at all. Let's pull back the curtain. Inside every prime brokerage, there's a hidden hierarchy, a secret ranking of all their clients. This isn't about how much money a fund manages. It's about their strategic importance to the bank. A Tier 1 client is a golden goose. They get favorable terms, more flexibility, and a helping hand during market stress. But a Tier 3 client? They're at the bottom of the food chain. The moment volatility spikes, their lifeline gets cut first. This isn't just a theory. Remember Archegos? The reason some banks lost billions while others walked away unscathed was this internal liquidation ladder. The banks that had Archegos ranked as a lower-tier client pulled the plug first, triggering a domino effect. The client's fate was sealed not by their portfolio losses, but by their secret ranking inside the bank. A fund can be downgraded from a high-priority bucket to a low-priority one without even knowing it. Suddenly, their positions are marked more aggressively. Margin calls become relentless, and their window to react shrinks to nothing. By the time they realize what's happening, the forced liquidation is already in motion. We've seen this play out time and again. Take Volmageddon in 2018. The VIX index exploded, and prime brokers instantly recalibrated their risk models. But they didn't just ask everyone for more margin. Instead, they secretly downgraded entire categories of clients running volatility-sensitive strategies. Their access to leverage was slashed by up to 30% overnight, not because of new rules, but because they were moved into a more restrictive bucket. This forced them to sell, which pushed the market down further, which in turn validated the bank's stress models, leading to more downgrades. It was a self-fulfilling prophecy, a vicious cycle completely invisible to the outside world. The same thing happened in March 2020 during the Treasury market meltdown. As liquidity vanished, prime brokers needed to protect their own balance sheets. So what did they do? They tightened the internal leverage buckets. Hedge funds running perfectly sound Treasury strategies suddenly found their financing evaporate. They were forced to sell, not because their trades were bad, but because their prime brokers simply ran out of balance sheet to support them. Meanwhile, the high-priority clients kept their financing, because unwinding them would have been too chaotic for the bank. The public saw a Treasury crisis, but the real story was the frantic, behind-the-scenes reshuffling of hedge funds between leverage buckets. So how does a fund get moved from a safe bucket to a dangerous one? It all starts with the prime broker's internal stress score. This is a complex metric that tracks everything: market liquidity, volatility, counterparty risk, and how a client's positions correlate with the bank's own exposures. For example, if high-yield credit spreads widen just a little, the bank system automatically tightens the buckets for any fund with significant credit exposure. If foreign exchange volatility doubles, macro funds get downgraded. These triggers are the first domino. The bucket reclassification is the second, and forced selling is the third. This brings us to an uncomfortable truth. Hedge funds aren't really in control of their own leverage. Prime brokers are. The banks decide when leverage expands and when it contracts, and these decisions are based on their own internal needs, not just market conditions. In September 2019, for instance, a sudden funding squeeze in the repo market caused rates to spike to 10%. Even though the stock market was calm, prime brokers started tightening leverage buckets for their clients. Why? They needed to preserve their own balance sheets for repo operations. The clients were left wondering why their financing suddenly got more expensive, completely unaware that it had nothing to do with their own risk. Another hidden factor is what's called internal netting efficiency. If a prime broker has clients who are long tech stocks and other clients who are short tech stocks, the risks cancel each other out. The bank is happy and can offer generous leverage to everyone. But what happens when everyone piles into the same trade? In 2021, almost every fund was long tech. The bank's internal risk models flashed red. Their net exposure to tech stocks was through the roof. So, they quietly moved their tech-heavy clients into more restrictive leverage buckets, forcing them to reduce their positions all at once. The news reported that hedge funds were de-risking from tech. The reality is, the prime brokers forced their hand, and it gets even more complex. The prime brokers are all watching each other. They don't share client data directly, but they can see the footprints. If one bank sees a hedge fund suddenly drawing more leverage, it might be a sign that another bank has tightened its terms. Fearing they'll be the last one holding the bag, other brokers will preemptively downgrade that client's bucket too. This creates a chain reaction across the entire financial system. During the UK gilt crisis in 2022, banks saw patterns of stress across their clients and started restricting leverage even for funds that had no exposure to UK bonds. They were acting defensively, anticipating a system-wide problem. So these leverage buckets are not a simple, linear system. They are a dynamic, interconnected web that responds to market signals, internal bank needs, and client behavior, often updating by the hour. They decide who gets leverage, who loses it, and who gets liquidated first. A hedge fund might think it's managing its risk, but it's actually just navigating a hidden architecture that can change without warning. And here is the most critical part. These internal leverage buckets change asterisk before asterisk the market moves. They are the earliest warning sign of systemic stress. The invisible reclassification of clients inside prime brokerages happens, long before the rest of us even sense that danger is on the horizon. The real danger isn't leverage itself, but the illusion of stability it creates. We've always had leverage in the markets. What we can't handle is leverage that vanishes without warning, disappearing in the gap between two internal risk meetings at a prime brokerage. It's leverage that looks abundant from the outside, but is already being rationed from within. We all picture hedge funds as these titans of risk, wielding massive balance sheets and intricate strategies. But the deeper truth is that these funds operate within a financial architecture they don't control. And when stress hits, that architecture contracts faster than any risk model a fund could ever build for itself. Imagine a portfolio that looks perfectly hedged. All the exposures seem balanced. The volatility metrics are suggesting calm waters. But if the prime broker has quietly shifted that fund into a more restrictive leverage bucket, all those assumptions just collapse in an instant. This is the silent, hidden asymmetry of our modern markets. The prime brokerage, or PB, sees the risk building up long before the fund does. And the decisions the PB makes in those early moments unseen, undocumented and unannounced will determine whether the next week is just a calm repositioning or a brutal, forced liquidation that makes front-page news. Now, think about what happens when several PBS shift their internal buckets at the same time. The consequences ripple out far beyond just one or two funds. Suddenly, liquidity vanishes from entire asset classes that looked solid just hours before. Correlations spike where none existed. Trading strategies that relied on easy financing fall apart under the weight of sudden margin calls. The market moves that look like they were driven by fear or speculation are actually just the mechanical output of this bucket compression. It's the silent withdrawal of leverage across dozens of PB desks, all trying to protect their own balance sheets. This is exactly why crises feel so sudden, even when the warning signs were there all along. The very first movements, the initial tremors, happened inside the PBs, not on the price charts you see on your screen. So, for anyone watching the markets today, the final warning is simple. The next crisis won't start on a trading floor or in a central bank statement or even on a macro chart. It will start where this system begins to shift inside the internal leverage buckets that sit within prime brokerages. These buckets are constantly adjusting risk classifications with every tick in volatility, every fracture in liquidity, every tightening in the funding markets. When these buckets begin to compress, they do so long before the rest of the world has any idea what's happening. By the time the effects hit our screens and news headlines, the liquidity needed to prevent a full-blown cascade has already been withdrawn. Let's be clear. The problem isn't that PBs are malicious. The problem is that they are self-preserving. Their risk models tell them when systemic fragility is on the rise, and they respond in the only way they know how, by tightening their internal constraints. But every single contraction inside that system becomes an amplification outside of it. It creates a vicious feedback loop. A hedge fund is forced to reduce its leverage, so it sells assets. Other funds see the price move and react, maybe selling as well. The PBS observe this new market stress and tighten their buckets even further. As more buckets compress, stress builds, and the whole financial architecture starts to creak under the pressure of simultaneous deleveraging. In this sense, these internal leverage buckets are not just simple risk controls. They are the hinge between stability and disorder. They are the mechanism through which PBS translate their own internal stress into market-wide consequences. If there is one lesson for investors, policymakers, or even seasoned insiders, it is this: never assume leverage is what it appears to be. Never assume that financing will be there tomorrow just because it was there yesterday. And never, ever assume a prime brokerage relationship is stable just because the surface looks calm. The system underneath is always in motion. It's constantly responding to signals that clients don't see and that regulators often don't monitor. The lights dim one switch at a time, slowly enough that only the PB notices, and then suddenly enough that the rest of the market feels the shock. And when that moment comes, when all the internal models start pointing in the same direction and the buckets begin to shift in unison, you won't hear an announcement. You won't see a headline. What you will see is liquidity thinning out, bid-ask spreads widening, and entire strategies unraveling in ways that feel completely inexplicable. That is, until you remember the truth. Markets don't just move on their own, they are moved. And in the world of leveraged finance, the first hands that move them belong to the prime brokerages, tightening their unseen buckets in the dark. So, watch carefully, listen for the silence, and understand that when the quietest part of the system begins to change, the loudest consequences are already on their way. The only real question is whether you recognize that shift before it reaches the surface or after it has already rewritten the entire landscape around you.